Hello, my name is Alexandra Smith, and this is my financial analysis of the 5 different companies from 2 different industries, and I will be picking which ones from both that I like the most based on these ratios. The 2 industries that I chose for this project is construction and oil and gas. In the construction industry, the companies chosen were AECOM, which is ACM, Jacobs Engineering Group, JEC, Caber Inc., KBR, Maztec Inc., MTZ, Primoris Services Corp., PRIM, and then from the oil and gas industry, I chose companies Plains All American Pipeline, LP, which is also PAA, Spectra Energy Partners, LP, at SEP, the DCP Midstream LP at DCP, and Kinder Morgan Inc., DE, at KMI. Throughout this analysis, I will be referring to their ticker symbols for the most part, so that you know which companies I'm talking about. There are 5 different categories that one should look at when analyzing an industry. They are going to be your short-term solvency, your long-term solvency, your asset management, your profitability ratios, and your market value ratios. And so the ratios that I chose to look at today are going to be my current ratio, my equity multiplier, also known as financial leverage, my cash coverage ratio, the total asset turnover ratio, return on equity, profit margin, and price to earnings ratio. To start things off, I'm going to talk about the current ratio for the construction industry. Now the current ratio tells us our current assets to our current liabilities, and that ultimately means that it tells us how much we have compared to what we owe. We want this ratio to be higher because for every $1 that we have in liabilities means that we would have X amount of dollars in assets. Now, on this slide, what it's showing you is that Maztec MTZ has the highest over the 5-year period, which it started off pretty high and then it worked its way up. It's upward sloping, and we like that. As opposed to JEC, whose is downward sloping, and KBR, which is just looks like it's going at a constant rate. Not much change, and then AECOM is upward sloping too, but it's a lot lower than Maztec, so we like Maztec the most because it is the highest and we want the most. This is the return on equity over the last 5 years from 2013 to 2017 for the construction industry. We see that KBR's ROE for year 2017 is significantly higher than Maztec, JEC, AECOM, and KBR. But they also had a huge decline back in 2014, and that is something we don't like because we don't want our companies to be sporadic all over the place. And so we like a more consistent form, which is Maztec in this case, because they start off high, they had a little dip, but everybody had a little dip back in 2014. And then they've steadily increased significantly higher than the other 3. As you can see, JEC's ROE is steadily declining with a slight rise from 2016 to 2017, but very minimal, and you want your return on equity to be high so that you can pay your shareholders back. Total asset turnover is telling us how well our company is putting their assets out there to sell and how fast they are converting that into sales. Now, Prim is the highest total asset turnover of the construction industry, which all the other ratios they weren't doing too well in. KBR's total asset turnover, which in the previous ratios that we looked at, was higher than everyone else. But this shows us that they are not doing a good job of managing their assets and being able to sell them quickly. Then Mastech stays and continuously grows. It has a little dip, but JEC's is going down, which we don't want to see in our asset turnover. We don't like that. And we do like that ACOM's is going up, but it's still not enough to compete with the others. For our financial leverage, we do not want that to be high. If we do have a high financial leverage or equity multiplier, we want an equal return or higher return, because that means that we are taking on more risk. So that means we should have more reward. Now, ACOM is up there with risk, but in their previous ratios, they weren't doing well enough to have a high. It means that their financial leverage, their equity multiplier, is too high, and they are making too many promises to pay off money when they don't have enough money coming in. And that's the same for KBR, and that is why we don't want a higher financial leverage, because it's not good. You're making more promises, but it is cheaper than having equity, but we do not want it to be high. And Mastech, in this case, is doing pretty well, and they are declining, and so is JEC, but they also aren't making money. Here I have ranked the profit earnings ratio and the cash coverage ratio from the highest to the lowest, and we want these to be higher so that we know what we're thinking of our future compared to our past, and to see how well we are doing with being able to cover our interest expense. And this is for the year of 2017. So Prim has a very high outlook, positive outlook on their future with 19.59. And then JEC's 1876, Mastech 1801, ACOM 1591, and KBR at 1337. Now, although Mastech isn't the highest in this category, I think overall they have been consistent with everything. They have a lower financial leverage equity multiplier ratio. They have almost the highest in the other categories that we want, and that is why I'm choosing Mastech to be the company that I choose for the construction industry. And even though their cash coverage isn't as high, they also don't have that much debt to have to cover in order to pay their people back. Now we are going to analyze the current ratios and the other ratios for the oil and gas industry. Here, Plains All-American Pipeline is consistently higher than all the rest, besides that large increase from DCP in 2015, but DCP was rather all over the place, and so I wouldn't recommend going with them because their current assets to current liabilities is sporadic. The return on equity for oil and gas industries are rather all over the place. We see that PAs started off high in 2013. As with all the others, it declined for the last 4 years, and then it went back up in 2017, which is good because all the other companies are going down, and we do not want our ROE to go down because everybody wants them to be high so that we are profitable. Profit margin. So SEP's profit margin was much higher than all the rest of the oil and gas industries companies. But it is on a fast decline compared to the others. Now, PAA's is rather low, but they have been consistent the whole time. They haven't had a huge decline or increase compared to DCP, which had a higher increase, but then has gone down. But PAA's is still above DCP's. Now, although it's below the profit margin for SEP, it is still doing better than SEP in general. Total asset turnover. Again, we are looking at how our sales are doing relative to our total assets. And we want this to be higher. PAA's is much higher than the rest of them, and it started off high. It did have a huge decrease, but it's growing again compared to DCP's, whose was growing but is now declining, and SEP's, whose profit margin was very high, but their total asset turnover is very low and is declining. Earlier, we mentioned that we wanted our financial leverage to be low, but if it is high, we wanted to have a high return. Well, PAA's company is doing better in the long run compared to all the other oil and gas companies that we have. But their financial leverage is much higher than the rest. So it seems our conclusion from our financial leverage is that they are generating a lot of their revenue from using debt. Here are the profit earnings ratio and the cash coverage ratios for the oil and gas industry. We see that DCP's is the highest and PAA's is the lowest for the year of 2017, which we know that DCP wasn't consistent the entire time that they were being analyzed, and PAA's was. So that's why I feel confident enough to voice my opinion that the Plains All-American Pipeline LP should be invested in this category. Now, overall, I would not choose from the oil and gas industry because they are very dependent on how well the market is doing, and I would choose from the construction because their numbers were more concise and more put together. They didn't vary very far. Their standard deviations were not as bad as the oil and gas company, and that's why overall I would choose Mastech to invest in as opposed to PAA, which is the Plains All-American Pipeline LP. Thank you so much. I hope you enjoyed this presentation and financial analysis of these industries, and I think you should invest in Mastech Corp.